The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, and welcome to the Pensionmark webinar series on taking the pulse of the market, using today's wealth for tomorrow's goals. We certainly appreciate all of you taking the time to join us today. A few items to go over before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And at the end, we will take some time to go through these. Now I'd like to introduce our guest speaker of MassMutual, Patrick Kellogg. Patrick is a retirement education specialist and has been helping people understand investments and prepare for retirement for over 19 years. He has been a financial advisor, and he has taught thousands of people across the country on how to create a solid foundation for retirement savings. Thank you, Patrick. We appreciate you sharing your time and knowledge with everyone here today, and now I will pass it over to you.
Great. Thank you, Tori, and thank you, everybody, for being on the presentation today. We really appreciate having the opportunity to speak with you today. We call this presentation Taking the Pulse of the Market, because that's really what we need to do every now and then, is take the pulse of the market, see how things are doing, see what its vital signs are, see if it looks and feels like it's healthy, like it's going to do well going forward. So that's what we're going to do. And during this presentation today, there's several things that we're going to discuss. I always like to start off with a quote from one of my favorite philosophers, Yogi Berra, the baseball great. He said, if you don't know where you're going, you might wind up someplace else. And I find that's definitely true. So let's talk about where we're going during this presentation. We're going to talk about market performance, how the markets have done in recent years, how we can set realistic expectations for our investment portfolios, your retirement plan and any other investments you might have, and some things to take into consideration when diversifying, when making sure that you've got your money spread out in enough different investment baskets. So that's what we're going to discuss during this presentation. Now, the one thing I'll say before we get started is everyone's financial situation is different. So during this presentation, we won't be giving financial advice, and that's probably good because free advice is worth just about what you pay for it. But we will be getting a good perspective on where we are today and where we've been so that you can make a more informed decision about where you're going. Now, I'm just like you. I'm investing for my future, for my family, for the things that are important to me. I'm no expert on investments, but I do have the benefit of experience, so I just want to share some of that experience and some data with you. So as we go through the presentation, let's take a look at the total percentage returns for different indexes. Now, first of all, an index, or indices as it says there, an index is a basket of stocks or bonds, kind of a benchmark that is often used to determine relative performance for a type of investment. And oftentimes people see the returns of indexes and they want to know, okay, well, that's what the fund, or that's what that index has done in the past. What's it going to do in the future? And of course, no one knows what's going to happen in the future. As Yogi Berra also said famously, it's tough to make predictions, especially about the future. And really, that's definitely true. I do not have a crystal ball. I can't tell what's going to happen in the stock market or the bond markets over the next few years. But while no one can predict how the markets will perform from year to year, we do use these indices like the Dow Jones Industrial Average and some of the others that we see here on the screen. They're frequently used as a measure of market performance. So you've got different types of indexes that cover different things. The Dow Jones Industrial Average, the S&P 500 Index, Barclays Capital Aggregate Bond Index, the Russell 2000, MSCI EAFE. So everyone does a slightly different thing. Now, the Dow Jones is probably the most famous of all the indices that we have here. A lot of people consider the Dow a substitute for the stock market. Or in other words, we hear the Dow quoted an awful lot. The Dow Jones Industrial Average was up 40 points today or dropped 13 points today or something like that. And a lot of people think that that is the stock market, when in reality the Dow Jones is a pretty narrow measure of the stock market. It's only 30 companies. 30 companies. Some of them have been around for a long, long time. Some of them are pretty recent additions to the index. But 30 companies gives you some idea how the overall stock market is doing, the U.S. stock market. but even though it's representative of several different industries, it doesn't give you a very wide cross-section. One that's more frequently used nowadays is the S&P 500 index, and as that suggests, it has 500 companies, not just 30 like the Dow, but 500 different companies whose stock price we're tracking. But these are 500 large U.S. companies. They're pretty good sized. A lot of them are the household names that you and I use their products all the time, day in and day out. So that does give us a little bit better idea, but it still ignores a few other things like small company stocks. That's where the Russell 2000 comes in. That has several different small company, smaller size companies under $2 billion in market capitalization usually, as opposed to some of these large companies that would be the S&P 500, which could be hundreds of billions of dollars in size. And then you've got bond indexes, you've got an international index like the MSCI EFA, and then you have indexes for even narrower sectors like a commodity index or a real estate index. These indices may not tell the whole story in terms of your portfolio, so don't compare your portfolio to just one or two. For each investor, a variety of indices can be used to measure the performance of an individual portfolio. Now, it's important to have a realistic yardstick of how your investments are doing compared to the relevant averages so that you can make informed investment decisions. Now, sometimes when you're doing that, the question often pops up, well, what if I've got a fund in my portfolio, in my retirement plan, or in some of my investments? What if my fund is underperforming the index? What should I do? And a lot of times the answer is nothing, because it might be a short-term performance issue. You know, your fund might be underperforming the index this quarter or this year, but does that mean that it's going to underperform the index forever? No, it doesn't. Does it mean that it's been underperforming the index for a long time? Well, not necessarily. You have to take kind of a longer view and look at some of the past performance. Has it underperformed the index for the last 5 years or 10 years? You know, that's when you definitely want to get a little bit more concerned. So it may be a short-term issue. It might be just a few key holdings that that one fund has, that maybe a few companies have had a rough patch, you know, rough year or so. So I wouldn't make a short-term decision and get rid of a fund just because in brief terms, you know, in recent history, it may be underperforming an index. Now, as you can see on the chart here for each of these indices, we're showing you what the returns are for the last few years, 2010, 2011, 2012, 2013. So the bar chart just kind of shows you if that index had a positive return or a negative return for each of those calendar years. Now, again, this is all rear-view mirror information. This is what has happened in the past. Does this tell you what's going to happen in the future? Definitely not. Past performance does not guarantee future results. And since this presentation was done actually at the end after 2013 was over, so it's a little bit dated. We don't have the information in there for 2014. Year-to-date performance for some of these indexes towards the end of 2014 here, the Dow Jones Industrial Average is up a little bit more than 6%, almost 6.5%, and this is through October. The S&P 500 is up about 10.3%. The Russell 2000, small companies, up only about 1.9%. So that's one thing to keep in mind. Russell 2000 small company stocks had a great year last year. Right now, they're in positive territory, but a little bit less than 2%. And the MSCI EFA International Index is down, actually, almost 3%, about 2.81% as of October or so. So those are some things to keep in mind. What goes up does eventually go down. Just to give kind of a snapshot of where we are today and kind of take the pulse of the markets overall throughout the whole world, global growth is slowing. And we'll see that in just about every country that you look at. Even in China, they're very concerned because their GDP growth is only going to be about 7.3%. Now, here in the United States, we would love to have 7.3% growth, but that's quite a bit lower than it has been in years past. It's down from the 10% range that they were seeing just a couple of years ago. So China is still growing, but just more slowly. And I think we're going to see that throughout the emerging markets countries. A lot of the developed world is definitely slowing down, and Europe, some people are feeling that Europe might be on the brink of another recession. So that's kind of the global view. Now, in the U.S., what's the outlook? U.S. markets are looking pretty good. I mean, the situation in the economy is looking okay. GDP growth in the United States is about 3%. Inflation is very low. We're even seeing oil coming down quite a lot, and that's going to help with overall inflation and prices. The Federal Reserve probably is not going to be doing any interest rate hikes anytime soon. Some people think it might be a couple different quarters before we'll see the Federal Reserve start to increase interest rates, and that could have a dampening effect on the economy, on growth. Our dollar is strong. There is definitely higher volatility in stock markets lately, and we've seen that this year, especially in October. We saw a lot of volatility. That's probably not going to go away anytime soon. We're probably going to have some volatility. We're going to have some price swings up and down. Valuations for stocks are mostly fair. Some people are definitely concerned about small cap stock valuations. The smaller companies, their valuations are getting a little bit higher. In other words, the price of a share of stock for smaller cap companies tends to be quite a bit higher than the usual historical average, the price versus the earnings ratio. And industrial activity is definitely on the increase, and we have pretty steady employment growth. So all that tends to make most analysts think that things are looking pretty good. Now, again, that's not a guarantee, that's not a prediction, but most analysts are saying things are looking pretty good for domestic stocks right now. So you just definitely want to make sure that you still have some invested there. Now, some people are always concerned with the volatility that we do see in stocks. As I mentioned, we've had quite a bit of volatility, and that's the roller coaster ride. You know, what goes up at times will go down. And we can see that when we take a look at the historical returns. And for this chart here, we are using the Dow Jones Industrial Average, even though, like I said, that's only 30 companies. It has the longest track record. They started measuring the Dow way back in 1896, 1897. And since its inception in 1896, Dow Jones Industrial Average has risen on a calendar year basis more than 60% of the time. In fact, in the 117 years that we're looking at on this chart here, 65% of the years had a positive return, and 34% of the years had a negative return. And that's what we can see. The purple bar charts, those were the years that we had a positive return, and most of the time you can see that the returns in the positive territory were usually between 0 and 10% on the positive side, 10 to 20%, and 20 to 30%. And then just a few years were kind of the outliers where there was even higher, we had even higher returns in the Dow Jones Industrial Average than that. The negative years, again, 34% of the time, the calendar year had a negative return in the Dow Jones, and most of those negative returns were between 0 and negative 10%, or between negative 10 and negative 20%. Again, just a few years were outside of those ranges. What that basically tells me is most of the time, you know, 2/3 of the time basically, stocks go up. 1/3 of the time stocks go down. The problem is nobody can know ahead of time. Nobody can time and figure out exactly which are the negative years so that you can get out of stocks ahead of time. Nobody can time the market like that. Now, no one enjoys those bad years. Psychologically, we just don't like to see the value of our portfolios go down. We don't like to see minus signs on our statements. But we do have to take the bad years along with the good years to get the average returns. Again, the average return of the stock market or the Dow Jones Industrial Average has been about 10% for the past 50-some years. But to get that average, you have to take the bad years along with the good to get the 10%. And most people are going to do very, very well with something like a 10% growth rate in their stock portion of their portfolio. Another thing to keep in mind is that since the market always does have these periods of volatility, you can use those periods of volatility to buy selectively rather than sell. Don't sell when things go down. Buy things because they're now on sale. Some people, during those periods of time where the market's going down, decide, I'm going to buy some quality companies, some good companies that I think are going to be around for a long time. Other people will invest more in whatever has been down for a while. You know, whatever sector of the economy or whatever index has been down for a while, maybe I'm going to put some more money into that sector because those share prices are cheaper. So markets probably will be choppier for a while. Another thing to keep in mind is that, you know, the economy sometimes expands, sometimes contracts. Recessions are what we call the times that the economy contracts, and it always happens from time to time. Every few years or so, we're going to go through a cycle where the economy will contract. Even though recessions are unavoidable, over the last century, expansions of the U.S. economy tended to be much longer than recessions. So the times where the economy is growing tends to be a lot longer than the period of time where it's shrinking. And you can see that in just about any of the time periods here. The most recent time period that we put up there, 1980 to 2013, there were 5 recessions during that period of time. Recession, the average time that the recession lasted was about 18 months. There were 5 expansions during that period of time. Average time that an expansion that the economy was growing was 70 months, so quite a bit longer. So after enjoying one of the longest periods of economic expansion in U.S. history, many investors were unprepared for the most recent recession that we just went through. So as the economy is recovering, it's easier to put the last few years in perspective. A lot of this comes down to our attitudes and our behaviors. Sometimes we let our emotions guide us, and that's not usually the best thing to do long term. Along with expansions and contractions, with recessions and growth, we also talk in market terms about bulls and bears, bull markets and bear markets. A bull market is when the market is going up, prices tend to be going up. Bear market is when prices are going down. So in March 2009, just a few days before the current bull market that we've been in for the past couple of years, just before that started, they did a survey. Somebody did a survey and asked individual investors, how do you feel about this market? How do you feel about the U.S. stock market? Only 19% of investors said that they were bullish on U.S. stocks, that they thought that stock prices were going to go up. And it was kind of understandable because 2008, first part of 2009, things had been ugly. The market had gone down a lot, almost 50% during that period of time. So not too many people were optimistic about where things were going. But just a few days later, the market turned and started a long growth period. Just a couple weeks ago, towards the end of 2014, they did that same survey. 58% of Americans were bullish, were optimistic. Well, that's after a couple years of pretty good stock market performance. So the thing that we have to keep in mind is usually the best time to get into an investment is when things look bad. And it's counterintuitive. People don't like to do that. Also, another thing to think about is deeper recessions oftentimes lead to bigger rebounds. Now, fear and uncertainty during economic recessions leads a lot of people to make short-term decisions that actually wind up impeding their long-term financial goals. What are your long-term financial goals? You probably have some different ones, but a lot of us have similar ones. You want to retire with dignity, with enough money to live comfortably. You want to be able to travel, do some things, some enjoyable things that you want to do during your retirement years. You might want to have a second home. You might want to help some family members out with college. You might have a lot of different goals. So those are your long-term goals. Don't make short-term decisions that could negatively impact those, because those decisions might actually lock in your losses during a recession. History shows that panicked investors that stop investing during recessions, they wind up missing out on market upswings during the recoveries that come afterwards, and we'll see that in a few slides. Now, since World War II, the U.S. economy has experienced 11 recessions, as you see on the screen there. Typically, the S&P 500 index has rallied in the 12 months immediately after each recession is over. History also shows that the deeper recessions are generally followed by larger stock market rallies. It's kind of like when you push that beach ball underneath the water. Now, the further down you push that, the more pressure is on it, but it's also wanting to bounce back, and when you release it, it tends to bounce back even higher. So one thing that is a caution is the next time that we have a recession, don't wait for an all-clear signal. Don't sit around waiting until someone says, all right, the recession's over. Now you can get back in the market. Because stock prices oftentimes start to rise just about as soon as economic conditions begin to improve, not when recessions are officially declared to be over. And usually we have to have 2 quarters, 6 months of positive GDP growth before the official designation will be that, all right, we're now out of recession. and the market can already be up by that point, by the time someone decides that. It's important to maintain realistic expectations. Stock market performance since the millennium has been nothing like it was back in the booming 1990s. It's very important that we maintain realistic expectations for the long term, and we still have to expect ongoing volatility. Now, if you're investing for more than a few years, keep in mind that the market has both bull and bear markets over time. So what's reasonable to expect? Well, some people focus on a shorter term period of time, like since 2000, from 2000 to the end of 2013. That's a 13-year period of time. Some people will think, well, that's long term. Well, during that 13-year period of time, stocks averaged about a 3.5% return, annual return over that 13-year period. Bonds, however, did much better, 5.7%, and cash averaged about 2% during that period of time. You might take a look at that 13-year period and say, well, bonds are a much better investment than stocks, so I'm just going to put all my money in bonds. Well, that doesn't give you the full picture. Even though 13 years is kind of a long period of time, most of us are saving for retirement, and our retirement is more than 13 years away, so we might want to take a longer-term view. Let's step back a few years. From 1970 to the end of 2013, that's 43 years. This is a little bit closer to the long-term historical averages. Stocks average about 10.3%. Bonds average about 7.9%. And that's actually pretty darn good for bonds. Bonds were having a bull market during much of that period of time because interest rates were coming down. And cash did okay at 5.3%. What this basically tells me is if I want to stay ahead of inflation, and inflation probably averaged about 3% during this period of time, stocks and bonds both did a pretty good period of time, or both did a pretty good job during this period of time of staying ahead of inflation. Cash, not so much. So what that tells me is I probably need to have a mix of stocks and bonds, but I have to have a realistic expectation. And when we go through a period of time where maybe there are a couple downturns or a couple of bear markets in a period of time, I can't just say, well, stocks are always going to perform that way. Again, there are periods of volatility, but we just have to keep a long-term perspective. Now, something that's interesting to use, kind of a rule of thumb, to determine how long it's going to take to double your money is something that we call the rule of 72. It's just a mathematical equation. It helps you calculate the length of time that might be necessary for you to double your investment, double the value of your investment. So here's how it works. You take the number 72 and you divide it by your investment's potential rate of return. And again, that takes a little bit of guesswork because we don't know exactly what things are going to return in the future. But let's say, for example, you've got your assets invested in a hypothetical 5-year CD, a certificate of deposit. Maybe that CD yields about 1.6%. So using the rule of 72, you take 72, you divide it by 1.6%. That tells you it would take about 45 years for that investment to double in value. Well, I don't have 45 years, so I probably need to put some of my money in something that's got a potential for growing a little bit more frequently, or a little bit more than that. So, if I put my money in something that has a potential of returning about 6%, then my money can double every 12 years or so. If I could put my money in something that could grow at about 8%, then every 9 years, the value of my portfolio could double. Again, there are no guarantees in the future, but that just tells you that if your money is all in something that's only returning 1 or 2%, it might take you longer than what you have time until you retire to be able to double the value of your investment. And most of us want to double and maybe even triple the value of our portfolios before we retire so that we have enough money to live on comfortably. Another caution is don't play it too safe. Don't assume that, if there's been periods of volatility, periods of time where the markets have not done what you wanted them to do, it takes time for those investments to bounce back. Investors that have experienced losses are often tempted to move into so-called safer investments, but that can prove riskier than they might imagine. This chart shows you hypothetical losses, 10% loss, 20% loss, all the way to a 50% loss, how long it would take or what rate of return you would need to get to break even, and then using the latest 30-year average annual returns for different types of investments, how long it would take you to recover if you were invested in cash or T-bills, bonds, or stocks. And for example, let's say I suffered a 20% loss in my portfolio. Well, if I need to get a 25% return just to break even, if my money was all in cash, it would take me around 5.6 years to get back to even. Using historical returns for bonds, it would take me about 2.7 years. In stocks, it would take me about 2.1 years to get back to even. And the greater the loss, obviously, the longer it takes to bounce back. But generally speaking, stocks give you the best likelihood of being able to bounce back from a loss. So don't move completely out of stocks into something safer that isn't actually safer. Another thing to keep in mind is regular investing can help smooth the ride when markets get choppy. This is the best thing to do in a choppy market, is keep investing on a regular basis. Investing the same amount at regular intervals, for example, every month or every pay period, which is what we do in our retirement plans, that's known as systematic investing, or we often call it dollar cost averaging. And that may be a better way to work towards your long-term goals. Dollar cost averaging has historically worked especially well in volatile times. Making investments of a fixed dollar amount at regular intervals, what it does is it buys you more shares when prices are lower, and you buy fewer shares when prices are higher. Over time, dollar cost averaging may lower the average price that you pay per share, and it can help smooth out the effects of volatility in a portfolio. So in the hypothetical example that you see on the slide, the lump sum investor, someone that just had $1,200 that they wanted to buy, they bought 120 shares on day one on January 1st and just let it ride. And the market went up for a little while, then the market went down for most of the year and came back up towards the latter part of the year in this hypothetical example. So they bought 120 shares. At the end of the year, they still had 120 shares. They paid $10 per share, so that was their average price, and that's what they had when they got back to the end of the year. The other person down below, dollar cost average, and they bought, instead of putting $1,200 into the market all at once, they bought $100 a month at whatever the share price was. So January 1st, they buy 10 shares, $10 per share. The next month, the market had gone up. They only bought 8.3 shares with their $100. In March, the market had gone up again. They wound up buying even fewer shares, because as the price goes up, I can buy fewer and fewer shares with my money. Then the market turned down, and what you notice is that every month when that money went in, as the market dropped more and more and more, that person was able to buy more and more shares. So at the end of the year, instead of only 120 shares, this person owned 144 shares, and the average price they paid was $9 per share. So they got a better price overall, average, and they now own more shares. And for most of us that have a long time to go until retirement, it's share accumulation. That's the key. How many shares can you buy? Because generally speaking, we expect that the investments that we own today, 10, 20, 30 years from now, when we're getting ready to retire and turn those into income, we're hoping that those share prices should be a lot higher than what they are today. So the more shares I can purchase today, especially at a lower price, should make me happier later on down the road. Now, dollar cost averaging, systematic investing, does not assure a profit, does not protect you against loss. Your account value can still go down, but you might wind up owning more shares of good investments over the long run. Now, we mentioned before, staying the course, not getting scared out of investments during bad times, maintaining that long-term focus on your investments. It's not always easy, especially when you watch the news. The news tends to tell you all the negative stuff. And economic news, different events can be distracting for any investor. And it makes it difficult to maintain that long-term focus. And you can look, during the 80s, during the 90s, during this millennium, we've had several things that have happened that have been pretty negative and have encouraged people or scared people out of the market. Now, consider October 19th, 1987. The Dow Jones Industrial Average dropped more than 20% in one day. So the market dropped a fifth of its value. Some indices dropped almost 25%, in a single day. It was the worst one-day decline in the stock market in 60 years. Now, if you try and find that on the screen, it's basically kind of a blip on the screen in the stock market's overall history of success. So we have to take these short-term drops in perspective. So what this graph is showing is, if you had $10,000 and you invested in the stock market back in 1980, and the stock market we're using the S&P 500 to be kind of a stand-in for the stock market, $10,000 in 1980 would have grown to $426,000 by the end of 2013. That's if you'd put it in the S&P 500 and just let it ride. And obviously we see there are several times on the chart where things went down in value, and then eventually they pop back up and down and up and down, and sometimes they drop quite a bit. But when you let it all ride, by the end of 2013, this person had $426,000. The person in purple started out, put $10,000 into the stock market as well, but every time one of these negative events came along and the market dropped by 20%, this person, the purple person, got out of the market and moved all their money into T-bills, basically into cash, and stayed in cash for 1 full year. And then they got back into the market, bought back into stocks after 1 year of sitting out on the sidelines. What happened to that person? Well, after the same period of time, that person still had pretty good growth in their portfolio, $240,000. Their $10,000 had grown to $240,371, but that's quite a bit less. That's 44% less than the $426,000. So stay informed about the news and keep up with your portfolio's performance, but keep those short-term events in perspective. Just know that there's always going to be bad news. Something bad is always going to happen and is going to make you think, well, maybe now it's time to get out. Bad news doesn't last. As you can see, the markets tend to keep going up over time. As long as you're investing in companies, and as long as those companies keep coming up with products and services that the world wants, then your long-term growth is going to continue to outpace bad news over the long run. Now, another thing to keep in mind is, we've mentioned before, diversification, making sure that you've got your money in a lot of different types of investments. And on this chart, you see a lot of different colors. Each color matches up with a type of investment: large company U.S. stocks, small company U.S. stocks, international, bonds, real estate, commodities, etc. And what you can see is, this chart is labeled, the top row is the best performing sector, the best performing asset class for each calendar year from 2003 through 2013, all the way down to the bottom row is showing you what the worst performer of this list of investments is each and every year. So what was the best, what was the worst? And what we can see is that the best performer changes pretty frequently. And there's really no pattern to it. There's no rhyme or reason. You can't just say, well, this is always going to be on top, because nothing's always on top. Even if one type of investment like real estate had a run there from 2010 to 2012 that was the best place to be, it's not always going to be the best. Commodities, that's another place to think about. Look at 2005. Commodities was the best place to have your money invested in 2005. Look at 2006. Where was it? It was the bottom of the list. 2007, it was back up. 2008, it was again at the bottom. Of course, everything was down in 2008 pretty much. The thing to keep in mind here is, don't try and time the market. Don't try and chase what's hot, because by the time you figure out something's hot and you get into it, it's now going cold. It's probably on its way down. So you just bought high, and then things are going to go down, and then if you get scared out, you're probably going to sell low. Buying high and selling low is not a good long-term strategy. For most of us, a much simpler strategy and a much more consistent strategy is to just diversify, spread your money out. If you look at the white boxes that are kind of in a band across the middle of the chart there, that is a diversified portfolio. For simplicity, we just put an equal percentage in all of those other categories: large U.S. stocks, small U.S. stocks, international stocks, bonds, cash, commodities, etc. The white portfolio, what you can see is that those white boxes are never in the top row. They're never going to be the best performer. Mathematically speaking, you're not going to do that when you've got your money invested in all the categories, but they're also not at the bottom. They're going to be more middle of the road. And for most people, when you take a look at the long-term averages of a diversified portfolio, it usually does pretty well, does well enough to stay ahead of inflation and help you grow your money over time. So the nice thing about the diversified portfolio is, whatever goes up, you've got some of your money in whatever goes up. Whatever goes down, you only have some of your money in whatever goes down. You don't have all of your money in there. So diversification makes sense long term. Most retirement plans offer more than just stocks and bonds. You might have real estate or precious metals or some commodities. There are extra risks in investing in some of these different categories, but it may help you diversify and add to your stocks and bonds. Another thing to think about when talking about diversification is looking outside of the United States. International financial markets today are much larger and much more accessible to U.S. investors than they were just a few decades ago. The dramatic growth that we've seen in the size and scope of the global financial marketplace has brought a corresponding increase in international investment opportunities. So by making sure that you've got some of your money invested outside of the United States, that might help you actually lower your overall portfolio risk, and you might get access to some of the world's best companies that aren't in U.S. markets, and it might help you improve your long-term portfolio performance. Over the last 10 years, the United States has been one of the top 5 performing developed markets only twice. You can see that on the chart there. Only 2 out of those 10 years has the U.S. been in the top 5. That means there's a lot of growth happening in other countries, and you want to make sure that you've got access to some of that. Now, not everything looks rosy right now. Definitely Europe has some concerns right now. Again, a lot of countries in Europe kind of poised for what might be a potential recession. Japan's been having a very rough go of it, economically speaking. But again, a lot of times the best time to invest are when things don't look the rosiest, because you can buy good companies at pretty good prices. So don't shy away from international investing just because of where we might be right now. So let's wrap this up. What are some different takeaways, some things that you can do to help with your retirement planning? It's important to keep all the different concepts that we've talked about investing. Keep these in mind as you develop and update your investment strategy. Make sure you maintain realistic expectations about market performance and returns. Don't expect to get a 25% return out of your stock portfolio over the next 10 years. It's probably not going to happen. But at the same time, just because stocks may have had a bad year, don't expect that they're always going to have a bad year. So keep that long-term perspective. Take that long-term view based on your goals, how much you want to have when you get to retirement, when you want to retire, and also based on your risk tolerance, how comfortable you are with the roller coaster ride. And remember that good times don't always last, but neither do bad times. So it's a long-term view. Don't try to time the market. No one can do it consistently. Don't try and get in and out at the right times, because you're sure to be wrong at some point, and sometimes people can be disastrously wrong. Diversify your portfolio. Just like with an athletic team, you want to make sure you have a deep bench. Make sure you've got good players in every position, and if one player gets injured, you've got someone else that can play that position. Same thing with your investments. Make sure you've got a really good, maybe a couple really good large company growth funds, large company value funds. Make sure you've got a few different international funds. Have that deep bench. Start your investment program early. The younger you are when you start saving for retirement, generally speaking, the better off you're going to be. And keep investing regularly, especially during the bad times. Don't pull back and stop investing for retirement just because the market happens to be down. Work with a financial advisor. You don't have to go it alone. Now, a lot of times financial advisors charge a fee for their services, but it's very helpful to have someone else that you can get some impartial advice from, bounce ideas off of, and have them help you set up a strategy, especially if you want a little bit of extra help. So I'll just wrap this up kind of like I started with Yogi Berra. Let's end with his words as well. He once said famously, "It gets late early out there." And it's the same thing with retirement planning. It gets late early out there. Retirement will be here before you know it. So you want to make sure that you're taking the steps right now and that you're on the right path so that when you get to retirement, you've got enough money saved up, you can live comfortably, you want to make sure that you're going to be retirement ready, and taking wise decisions about your investments are one important part of that. And again, making sure that you're saving enough for retirement is absolutely essential. So with that, I think I will wrap it up. Tori, I'll turn it back over to you.
Thank you, Patrick. We appreciate you leading us through that presentation today. Please remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu. And as always, you can reach out to your dedicated service team at Pensionmark for any plan-specific questions. And it would appear that we have no questions at this time, so this will conclude the webinar session. Again, thank you, Patrick, and thank you, attendees, for your participation. I hope you all have a great day, and we're looking forward to our next webinar with you. Take care.
Thank you.